Hello, this is Sophie Hammond and your Patent University online course instructor for this semester. We are in Risk Management, FIN610. We're going to be going over Unit 4 today, beginning with the overview and introduction. In this unit, we will cover risk management on the global and local scale. Risk can be managed through property risk management and liability risk management procedures. The term property refers to physical property, which is then separated into real property, permanent structures, or personal property, mobile property. A determination needs to be made on the payments, which is clarified by the valuation clause, deductibles, and co-insurance clauses, all concepts we will be covering in this unit. Furthermore, e-commerce has presented new challenges and risks, particularly in the business world. Hardware and software thefts, technological changes, regulatory and legal changes, and internet-based telephony crimes comprise this segment of risk. Businesses take a variety of measures to protect themselves against these risks with security products and processes, data protection and security, digital signatures, and more. In lieu of these measures, e-commerce property insurance is also available. As businesses trade across the borders, there are increased risks due to unstable political environments, increased terrorism, legal differences in laws, and culture barriers leading to risks. Liability risk management refers to wrongdoing to another person or organization remedied by offering compensation to the harmed person. This involves statutory laws, laws created by legislatures, common laws, laws based upon custom and court decisions, criminal laws, acts against public policy such as murder, and civil laws, acts that cause injury or loss to an individual or organization. Negligence, or the failure to act reasonably, is declared through the assumption of risk, contributory negligence, comparative negligence, last clear chance, and immunity stipulations. Differentiating and understanding property and liability risk is imperative to recognize how insurance might mitigate these risks. There are 3 learning objectives. The first is to interpret how global risk is reduced. The second is to appraise property risk management methods. And the third is to summarize liability risk management methods. So we will now be moving into Objective 1, which is to interpret how global risk is reduced. And we're going to begin with the first reading, Global Property Exposures. As with the internet, global exposure is rapidly growing for many companies. This forces management to think about the unique problems that arise when companies cross national borders, also known as global risk. Political Risk Services, an organization that ranks the countries for their instability, attaches a major cost to each country. This highlights the importance of understanding the countries that businesses decide to enter. In a survey conducted by the insurance broker Aon of Fortune 1000 companies in the United States, 26% of the respondents felt comfortable with their political risk exposure, and 29% felt comfortable with their global financial or economic risk exposure. While most respondents felt comfortable with their property or casualty coverages, only a small percent felt comfortable with their political risk protection. The survey was conducted in May 2001, before the September 11th attack. In 2005, Aon provided a map of the political and economic risk around the world. The climate around the world has changed with the war in Iraq, a part of the world surrounded by major economic and political hotspots. Political risk can be defined as unanticipated political events that disrupt the earning or profit-making ability of an enterprise. In the risk report, Managing Political Risks, insurance expert Kevin M. Quinley describes some of the perils that can affect a global organization: nationalization, privatization, expropriation, property taken by the host nation according to its laws, civil unrest, revolution, foreign exchange restrictions, labor regulations, kidnapping, terrorism, seizure, and forfeiture. Some of the risks are considered political risks, others are economic risks. Table 11.2 10 Ways to Tune Up Management of Political Risks, explains some of these risks. In summary, the main categories of global risk exposure are as follows: destabilized international political environment, heightened terrorism risk, legal risk due to changes in local laws, lack of data risk, currency inconvertibility risk, cultural barriers risks. According to the risk report, the nature of the risks has changed. 20 years ago, the major risk was in the area of nationalization of capital assets, while the perils of today are more related to economic integration and the power of international financial markets. Experts agree that political risk looms larger after September 11th, the war on Iraq, and the instability in the Middle East. Following the September 11th attack, Marsh and all large brokerage firms began providing political risk assessment services to clients worldwide. The consulting includes formulating and reviewing crisis management plans for events such as natural disasters, product recalls, and terrorism. The plans are comprehensive and they are integrated throughout the enterprise. Legal risk. Often, the decision to undertake operations in a particular country is made apart from any risk management considerations. Although the legal environment may have been carefully reviewed from the standpoint of firm operations, little information may have been obtained about insurance requirements and regulations. For example, in many countries, social insurance is much broader than the United States. There are few, if any, alternatives available to the risk manager. The risk manager may be forced by regulations to purchase local coverage that is inadequate to cover perils or limits of liability. Particularly in less developed countries, there simply may not be adequate insurance capacity to provide desirable amounts and types of coverage. The risk manager must then decide whether or not to ignore the regulations and use non-admitted coverage. Non-admitted coverage involves contracts issued by a company not authorized to write insurance in the country where a risk exposure is located. Admitted insurance is written by companies authorized to write insurance in the country where a risk exposure is located. Non-admitted contracts have advantages to some U.S. policyholders. They are written in English, use U.S. dollars for premiums and claims, thus avoiding exchange rate risk, utilize terms and conditions familiar to U.S. risk managers, and provide flexibility in underwriting. However, such contracts may be illegal in some countries, and the local subsidiary may be subject to penalties if the contract's existence becomes known. Further, premium payment may not be tax deductible, even in countries where non-admitted coverage is permitted. If non-admitted insurance is purchased where it is prohibited, claim payments must be made to the parent corporation, which then has to find a way to transfer the funds to the local subsidiary. Coverage is also affected by the codification of the legal system in the other countries. The Napoleonic Code, for example, is used in France, Belgium, Egypt, Greece, Italy, Spain, and several other countries. Under this legal system, liability for negligence is not treated in the same way as liability is treated under the United States system of common law. Any negligence not specifically mentioned in the code is dismissed. The common law system is based on legal precedents, and the judges play a much more significant role. Data risk. Another problem facing the international risk manager is the collection of adequate statistical information. Economic and statistical data commonly available in the United States may simply be non-existent in other parts of the world. For example, census data providing an accurate reflection of mortality rates may not be available. Even in industrialized countries, statistics may need careful scrutiny because the method used to produce them may be vastly different from that typical to the risk manager's experience. This is particularly true of rate-making data. Data may also be grossly distorted for political reasons. Officially stated inflation rates, for instance, are notoriously suspect in many countries. Faced with this lack of reliable information, the risk manager has little choice but to proceed with caution until experience and internal data collection can supplement or confirm the other data sources. Contacts with other firms in the same industry and with other foreign subsidiaries can provide invaluable sources of information. Data collection and analyses are a problem not only in this broad sense. Communication between the corporate headquarters and foreign operations becomes difficult due to the language barriers, cultural differences, and often a sense of antagonism about a non-citizen's authority to make decisions. Particularly difficult under these circumstances are the identification and evaluation of exposures and the implementation of risk management tools. Loss control, for instance, is much more advanced and accepted in the United States than in most other countries. Encouraging foreign operations to install sprinklers, implement safety programs, and undertake other loss control steps is generally quite difficult. Further, risk managers of U.S.-based multinational firms may have difficulty persuading foreign operations to accept retention levels as high as those used in the United States. Retention simply is not well accepted elsewhere. Currency risk. Any multinational transaction where payments are transferred from one currency to another is subject to exchange rate risk. Under the current system of floating exchange rates, the rate of currency exchange between any two countries is not fixed and may vary substantially over time. Currency exchange risk is in the high area of liquidity and convertibility between currencies. The risk exposure is the inability of the global firm to exchange the currency and transfer out of hostile countries. How this kind of risk can be mitigated is explained in Chapter 5, The Evolution of Risk Management, Enterprise Risk Management. Cultural differences risk. As we are very acutely aware after the September 11, 2001 attacks, cultural differences are at the root of much of the trouble around the world. But this is not the only hostile events. When a business expands abroad, one of the first actions is the study of local culture of doing business. If you ever were in the market in Old Jerusalem, you may have experienced the differences in shopping. You learn very quickly that a merchant never expects you to buy the item for the quoted price. The haggling may take a long time. You may leave and come back before you buy the item you liked for less than half of the originally quoted price. This is the culture. You are expected to bargain and negotiate. Another cultural difference is the connection or protection. Many business moves will never happen without the right connection with the people in power. Labor laws reflect another interesting cultural difference. In some countries, it is common to employ very young children, an act that is against the law in the United States. The families in these countries depend heavily on the income of their children, but an American business in such a country may be faced with an ethical dilemma. Should it employ children or adhere to U.S. practices in labor laws? Islamic finance is very different from finance in the Western world, for example. In Islam, interest payments are not permitted. With the expanded involvement of many businesses in the Middle East and Islamic countries, many academics, as well as business people, are learning about the special ways to conduct business there. Global risk management. The steps in global risk management include processes to reduce risk and develop loss control policies, along with obtaining the appropriate insurance. Table 11.2, 10 Ways to Tune Up Management of Political Risks, lists ways to manage political risks. The steps include learning the culture of the country and becoming a good corporate citizen, learning about the reality of the country, and finding ways to avoid political and legal traps. In the area of insurance, the global firm first looks for public insurance policies. The U.S. government established an insurance program administered through the Overseas Private Investment Corporation, OPIC, in 1948. The types of coverage available during expropriation, confiscation, war risks, civil strife, unfair calling of guarantees, contract repudiation, and currency inconvertibility. These are shown in Table 11.2, 10 Ways to Tune Up Management of Political Risks. OPIC insurance is available only in limited amounts and only in certain developing countries that have signed bilateral trade agreements with the United States for projects intended to aid development. Some private insurers, however, also provide political risk insurance. Private insurers do not have the same restrictions as OPIC, but country limits do exist to avoid catastrophe, dependent exposure units. Additional types of coverage such as kidnap, ransom, and export license cancellation are also provided by private insurers. Poor experience in this line of insurance has made coverage more difficult and costly to obtain. After September 11th, some insurers pulled out of the political risk market, while others took the opportunity to expand their global coverage offerings. A Canadian insurer reported that the demand for insurance for employee political risk and kidnap and ransom for a dozen global companies increased by 100%. Zurich North America and Chubb expanded their political risk insurance offerings to the Asian market. The private insurance market's ability to meet the demand has been strengthening each year because customers require broader coverage with longer terms, up to 10 years. Other companies expanding into the market are Bermuda's Sovereign Risk, AIG, and Reliance, among others. This section continues briefly, and there are key takeaways and discussion questions, but we will now be moving on to Objective 2, Appraise Property Risk Management Methods, beginning with the first reading, Property Risks. Property can be classified in a number of ways, including its mobility, use value, and ownership. Sometimes these varying characteristics affect potential losses, which in turn affect decisions about which risk management options work best. A discussion in classifying characteristics, including consideration of the hot topic of electronic commerce, e-risk exposures, and global property exposures follows. Physical property is generally categorized as either real or personal. Real property represents permanent structures, realty, that, if removed, would alter the functioning of the property. Any building, therefore, is a real property. In addition, built-in appliances, fences, and other such items typically are considered real property. Physical property that is mobile, not permanently attached to something else, is considered personal property. Including in this category are motorized vehicles, furniture, business inventory, clothing, and similar items. Thus, a house is real property, while a stereo and a car are personal property. Some property, such as carpeting, is not easily categorized. The risk manager needs to consider the various factors discussed below in determining how to manage such property. Why is this distinction between real and personal property relevant? One reason is that dissimilar properties are exposed to perils with dissimilar likelihoods. When flood threatens a house, the opportunities to protect it are limited, yet the threat of flood damage to something mobile may be thwarted by movement of the item away from flood waters. For example, you may be able to drive your car out of the exposed area and to move your clothes to higher ground. A second reason to distinguish between real and personal property is that appropriate valuation mechanisms may differ between the two. We will discuss later in this chapter the concepts of actual cash value and replacement cost new. Because of the moral hazard issues, an insurer may prefer to value personal property at an actual cash value, a depreciated amount. The amount of depreciation on real property, however, may outweigh concerns about moral hazard. Because of this distinction, valuation often varies between personal and real property. When property is physically damaged or lost, the cost associated with being able to use that property may go beyond physical loss. Indirect loss and business interruption losses discussed in the box, business interruption with and without direct physical loss, provides a glimpse into the impact of this coverage on businesses and the importance of the appropriate wording in the policies. In many cases, only loss of use of property that is directly damaged leads to coverage. In other cases, the loss of property itself is not a prerequisite to trigger loss of use coverage. As a student in this field, you will become aware of the importance of the exact meaning of the words in the insurance policy. General property coverage. The first standard fire policy, SFP, came into effect during the late 1800s and came to be described as the generally accepted manner of underwriting for property loss due to fire. Two revisions of the SFP were made in 1918 and 1943. Most recently, the SFP has largely been removed from circulation, replaced by homeowners' policies for residential property owners, discussed in Chapter 1, The Nature of Risk, Losses, and Opportunities. and the Commercial Package Policy, CPP, featured in Chapter 1, The Nature of Risk, Losses, and Opportunities. The SFP was simple and relatively clear. Most of its original provisions are still found in current policies, updated for the needs of today's insured. In light of the exchanges regarding terrorism exclusion that occurred after September 11, 2001, discussed in Chapter 1, the topic of standard fire policies came under review. The issue at hand is that under current laws, standard fire policies cannot exclude fires resulting from terrorism or nuclear attacks without legislative intervention. Types of property coverage and determination of payments. Once it is determined that a covered peril has caused a covered loss to covered property, several other policy provisions are invoked to calculate the covered amount of compensation. As noted earlier, the topic of covered perils is very important. Catastrophes such as earthquakes are not considered covered perils for private insurance, but in many cases, catastrophes such as hurricanes and other weather-related catastrophes are covered. The box, From Coast to Coast, Who is Responsible for Earthquake and Flood Losses, is designed to stimulate discussions about the payment of losses caused by catastrophes. Important provisions in this calculation are the valuation clause, deductibles, and co-insurance. We will now be moving into Objective 3 of Unit 4, beginning with the first reading, Nature of the Liability Exposures. Legal liability is the responsibility based in law to right some wrong done to another person or organization. Several aspects of this definition deserve further discussion. One involves the remedy of liability. A remedy is compensation for a person who has been harmed in some way. A person who has been wronged or harmed may risk the court to remedy or compensate him or her for the harm. Usually, this will involve monetary compensation, but it could also involve some barrier on the part of the person who committed the wrong, or the tortfeasor. For example, someone whose water supply has been contaminated by a polluting business may request an injunction against the business to force the cessation of pollution. A developer who is constructing a building in violation of the code may be required to halt construction based on a liability lawsuit. When monetary compensation is sought, it can take one of several forms. Special damages, or economic damages, compensate for those harms that generally are easily quantifiable into dollar measures. These include medical expenses, lost income, and repair costs of damaged property. Those harms that are not specifically quantifiable but that require compensation, all the same, are called general damages, or non-economic damages. Examples of non-economic or general damages include pain and suffering, mental anguish, and loss of companionship. The third type of monetary liability award is punitive damages, which was discussed in our Punitive Damages Out of Control in Chapter 10, Structure and Analysis of Insurance Contracts. In this chapter, we will continue to discuss the controversy surrounding the use of punitive damages. Punitive damages are considered awards intended to punish an offender for exceptionally undesirable behavior. Punitive damages are intended not to compensate for actual harm incurred, but rather to punish. A second important aspect of the definition of liability is that it is based in law. In this way, liability differs from other exposures because it is purely a creation of societal rules, laws, which reflect social norms. As a result, liability exposures differ across societies, nations, over time. In the United States, liability is determined by the courts and by laws enacted by legislatures. The risk of liability is twofold. Not only may you become liable to someone else and suffer loss, but someone else may become liable to you and have to pay you. You need to know about both sides of the coin, so to speak. Your financial well-being or that of your organization can be adversely affected by your responsibility to others or by your failure to understand their responsibility to you. You would be the plaintiff in litigation. The party being sued in litigation is the defendant. In some circumstances, the parties will both be plaintiffs and defendants. Basis of liability. The liability exposure may arise out of either statutory or common law, as shown in Figure 12.2, Basis of liability risk. Statutory law is the body of written law created by legislatures. Common law, on the other hand, is based on custom and court decisions. In evolving common law, the courts are guided by the doctrine of stare decisis, Latin for to stand by the decisions. Under the doctrine of stare decisis, once a court decision is made in a case with a given set of facts, the courts tend to adhere to the principle thus established and apply it to future cases involving similar facts. This practice provides enough continuity of decision-making that many disputes can be settled out of court by referring to previous decisions. Some people believe that in recent years, as new forms of liability have emerged, continuity has not been as prevalent as in the past. As illustrated in Figure 2.2, Basis of liability risk, the field of law includes criminal law and civil law. Criminal law is concerned with acts that are contrary to public policy, crimes such as murder or burglary. Civil law, in contrast, deals with the acts that are not against society as a whole, but rather cause injury or loss to an individual or organization, such as carelessly running a car into a side of a building. A civil wrong may also be a crime. Murder, for instance, attacks both society and individuals. Civil law has two branches, one concerned with the law of contracts and the other with the law of torts, explained in the next paragraph. Civil liability may stem from either contracts or torts. Contractual liability occurs when the terms of a contract are not carried out as promised by either party to the contract. When you sign a rental agreement for tools, for example, the agreement may provide that the tools will be returned to the owner in good condition, ordinary wear and tear excepted. If they are stolen or damaged, you are liable for the loss. As another example, if you offer your car for sale and assure the buyer that it is in perfect condition, you have made a warranty. A warranty is a guarantee that property or service sold is of the condition represented by the seller. If the car is not in perfect condition, you may be liable for damages because of a breach of warranty. This is why some sellers offer goods for sale on an as-is basis. They want to be sure there is no warranty. A tort is a private or civil wrong or injury other than breach of contract, for which the court will provide a remedy in the form of an action for damages. That is, all civil wrongs except breach of contract or torts. A tort may be intentional if it is committed for the purpose of injuring another person or the person's property, or it may be unintentional. Examples of intentional torts include libel, slander, assault, and battery, as you will see in the contracts provided as appendixes at the end of this book. While a risk manager may have occasion to be concerned about liability arising from intentional torts, the more frequent source of liability is the unintentional tort. By definition, unintentional torts involve negligence. If someone suffers bodily injury or property damage as a result of your negligence, you may be liable for damages. Negligence refers to conduct or behavior. It may be a matter of doing something you should not do or failing to do something you should do. Negligence can be defined as a failure to act reasonably, and that failure to act causes harm to others. It is determined by proving the existence of 4 elements. Sometimes people use 3, combining the last 2 into 1. These 4 elements are the following. Number 1, a duty to act or not to act in some way. Number 2, breach of that duty. Number 3, damage or injury to the one owed the duty. And number 4, a causal connection called the proximate cause between the breach of a duty and the injury. An example may be helpful. When a person operates an automobile, that person has a duty to obey traffic rules and to drive appropriately for the given conditions. A person who drives while drunk, passes in a no-passing zone, or drives too fast on an icy road, even if within set speed limits, has breached the duty to drive safely. If that person completes the journey without an incident, no negligence exists because no harm incurred. If, however, the driver causes an accident in which property damage or bodily injury results, all elements of negligence exist and legal liability for the resulting harm will likely be placed on the driver. A difficult aspect of proving negligence is showing that a breach of duty has occurred. Proof requires showing that the reasonable and prudent person would have acted otherwise. Courts use a variety of methods to assess reasonableness. One is a cost-benefit approach, which holds behavior to be unreasonable if the discounted value of the harm is more than the cost to avoid the harm. That is, if the present value of the possible loss is greater than the expense required to avoid the loss. In this way, courts use an efficiency argument to determine the appropriateness of behavior. A second difficult aspect of proving negligence is to show a proximate cause between the breach of duty and resulting harm. Proximate cause has been referred to as an unbroken chain of events between the behavior and harm. The intent is to find the relevant cause through assessing liability. The law is written to encourage behavior with consideration of its consequences. Liability will not be found in all circumstances just described. The defendant has available a number of defenses, and the burden of proof may be modified under certain situations. The reading goes on a little to talk about defenses. Feel free to read that on your own. There is also a Unit 4 review with extra resources that are for your benefit. However, this concludes our Unit 4.